Okay, good afternoon. Welcome to Accounting with Madam Mombi. So today we are going to look at what is accounting. I don't know what comes to your mind when you hear the word accounting. To several people, they think about money. To others, they think about bookkeeping, that is recording of transactions. To others, they even think about calculations. But I want to look at broadly now. What is the accounting? So fast forward, we are going to introduce what is accounting. So accounting is the whole process of identifying transactions, measuring those transactions, classifying them, summarizing them, and communicating that information to users so that they can be able to make informed decisions. So let me give you an example. If you think about in an organization that a sale has occurred, you start by identifying that transaction, that the transaction is a sale. Then you measure, you ask yourself how much was the worth of the transaction. So in this case, how much was the figure for the sales or the amount of the sales? Then you classify that sale either as a cash sale or a credit sale. Then you, after classifying, you can also now communicate that information to enable informed decision by managers. They are able to know when if it's a credit sale, when it is payable, and so on. Again, all this information is consolidated now in form of financial statements, which are then communicated to the users. So accounting is broad. It is not simply recording. It is more than that. It is about identifying transactions, measuring them, summarizing them, classifying them, and finally communicating that information to users. So, then the next question would be, what is the objective of accounting? The primary objective of accounting is to provide information. So, accounting helps people to know certain things in the organization. For example, accounting helps us to know what is the cash flow position. How much does the business have in terms of money? What is the liquidity position? Are they able to meet their obligations when they fall due? So, by accounting, we are able to know what is the cash flow position of our business. Another one, we are able to tell about the profitability of the business. Is the business making a profit or a loss? And that again is going to help us to make several decisions on whether maybe to continue operations, probably to cut the operations, to improve on certain aspects of efficiency, depending on whether the business is making profit or loss. Accounting also provides information about the worth of the business. Now, when you think about the worth of a business, you have to think about number one, the assets. That is, what are the business asset position? How many assets and of what worth does the business possess? You will also look at how much is the debtor's position. How much money is the organization owed by other people. You're also going to look at the debt position or the leverage. How much does the organization owe to other people who are outside the organization? So all these combined, which we're going to look at later in the statement of financial position, helps us to know the worth of our business. So the worth of our business is all those things put into perspective. Then I mentioned at the introduction that accounting provides information, but to who? Maybe you're asking yourself, who needs this information? So this brings us to the users of accounting information. Who uses the accounting information? We have number one, we have managers. Managers are the people who are inside the organization. They do day-to-day running of the organization. They are the ones in charge of the affairs of the business, and they have a reason to be interested in the financial information. They need to know whether the business that they are managing or running is able to achieve its goals. They are also able to check and analyze themselves as managers, whether they are able to propel the business in the right direction. And as managers, they also need to make daily decisions. So those daily decisions require them to have all the accounting information. Another category of users is investors. Investors can be classified into both both existing and potential investors. Existing investors have already invested their money in the business. They need to know whether they are getting a return on their money. While potential investors, they want to invest in the business and they would like to know whether it is worthwhile for them to invest in the business by looking at how that business is performing. Okay. Another user are creditors. Creditors, these are people who supply goods on credit to the organization. They have supplied goods to their business on credit. They want to know whether the business is capable of paying them on time, whether the business has the capability to pay how much is owed to them on time, and that is why they would be interested in the information. Another top user is lenders. These are also can be noted as financial institutions because they provide finance to the business. They are the people who provide money, that is the SACCOs, the banks, the microfinances. They provide finance to the business. Before they give this finance, they need to evaluate whether the business is capable of paying back. That is, what is the credit worthiness of this potential borrower. So when you go to borrow in the financial institutions, they want to see your financial statements for a period of maybe 4 years, 5 years, and they can assess your ability to be able to meet the debt obligations. And what is your credit worthiness, how much you can be lent. Another user are employees and labor unions. Employees, being part of the organization, they need to know about their job security. They also need to know about their bonuses. Now, by evaluating the financial position of their business where they are employees, they can be able to tell if the business is growing, whether the business has future prospects, or the business is heading towards liquidation, in which case they have to be worried about their job security. They also need to know the bonuses that are payable to them depending on the profitability. How profitable the business was is going to determine how much bonuses they are going to receive. So labor unions, they are usually there to negotiate for employees' welfare, and as they do so, they require information about the business so that they can be able to bargain for employees' salaries and wages. Okay, another very interesting user is the government, and the government requires this information for two reasons. Number one, when they are computing national statistics. Number two, they want to know for tax purposes in terms of when they are computing tax liability or how much every business should pay in tax. So the government is a key user of financial statements. When they compute national statistics, they want to know the growth of the economy and such issues, and they have to look at holistically individuals and businesses. So we're also going to look at researchers. Researchers would be like ourselves as scholars. We want to do a topic probably in research or evaluate certain aspects or factors affecting businesses and their performance. We would be very interested to find out how those businesses are performing by looking at their financial information. So researchers say that financial statements are the mirror. They act as the mirror of the business conditions. They show how the business is performing. Therefore, researchers are very key users of financial information or financial statements information. And finally, the last but not the least are the shareholders. Now, shareholders are owners of these businesses. As much as they have delegated management to managers, they are the ones who have provided the capital. And they need to know what is the return on their capital, the return on equity, and also be able to tell whether the business has future prospects. So, fast forward, we're going to now look at branches of accounting. So there are different branches of accounting that we're going to be introducing. The first one is financial accounting. And this is the most common branch of accounting. This is the one that we talk about most of the days because it is where we find the trading profit and loss account, we find the balance sheet. So financial accounting is a branch of accounting that focuses on providing information to both internal and external users. It evaluates the business holistically in terms of the whole business, how it is performing. So this is the major branch of accounting that provides information to both internal and external users and focuses on the whole organization. Another branch of accounting is management accounting. Now, management accounting, from the word management, it is a branch of accounting that focuses on providing information to managers. That is the internal users. Now, the issues in management accounting are not issues that are broadcasted externally. For example, a budget, which is a tool for planning, is an item you find in a management account. Variance analysis, performance measurement, these items are internal to the organization, but they are key. They have to be provided to the managers so that they are able to make informed decisions. So management accounting focuses on providing information to internal users. That is management. And we have mentioned the items you would find there like budget. That you don't go telling everybody this is my budget, but it is provided internally. Another branch of accounting is cost accounting. So cost accounting deals with all issues about cost: inventory control, cost control, pricing, cost ascertainment, cost control, and all items in regard to cost are taken care of by this branch of accounting. So cost accountants, their responsibility is to monitor all the costs, to be able to also make sure that they ascertain all the costs and they control all the costs in the organization. So of course, so that we can enhance efficiency and effectiveness of an organization. So that is another branch of accounting, number 3, which we have called cost accounting. Another branch of accounting is taxation. Now this one needs no introduction because taxes, everybody of us would know what they are. So taxation is a branch of accounting that focuses on tax liability. How much should individuals pay as tax? How much should companies pay as tax? So taxation is a branch of accounting that looks into evaluation or determination of tax liability. And it looks at the different types of taxes, how they are levied, when they should be remitted to the government, and the procedures and penalties that may be involved. So this is a branch of accounting that as much as we may not even know much about it, we know in terms of everybody here can attest that they are paying taxes. So finally, the 5th category or branch of accounting among these other key branches of accounting is auditing or auditing, which is a branch of accounting that deals with the independent examination of the books of account by a professional accountant so as to determine whether the financial statements as provided, they are able to reflect a true and fair view of the state of affairs of the business. You are able to tell through auditing whether the financial statements are clear, are complete, and they are truthful in terms of fair representation of the affairs of the business. So this one is done by professional accountants, who are known as auditors, and they provide a report after evaluating those financial statements. So these are the key 5 branches of accounting. You may find that there are others like forensic accounting, but they would fall broadly under these categories because would also even be probably a form of investigative accounting, but accounting majorly classifies into these 5 branches. So I want to think about, I mentioned this, is accounting the same as bookkeeping? It is a layman way of thinking that accounting is equivalent to bookkeeping, because as we have mentioned is that accounting is much wider. Now, while bookkeeping is only the act of recording without a purpose, without a format, you can record in any manner that suits you and maintain the books as you wish. Accounting is much more than bookkeeping. Accounting is a whole process that is governed. Accounting is a whole process that has a regulation, and it is a whole process of doing much more than just recording. It goes into summarizing, interpretation, communication of financial information. So I'll just simply say that accounting is much wider, accounting is much bigger. Accounting is not bookkeeping, it is bigger than it. So the next thing we would ask ourselves in an introduction to accounting is, what is the accounting equation? This is one of the key things that you need to know as an accountant. The accounting equation is what we say that assets is equals to capital plus liabilities. And I want to explain this. If you want to explain how you have acquired all your assets or your net worth in terms of assets, then it will mean 2 things. In a business, it is the sum of the funds that the owner introduced into the business, which we refer to as capital. This is the amount that the owner introduced into the business, and then maybe it was not sufficient to be able to acquire all the assets that they require for business. That is why they resort into borrowing. And these are funds, liabilities, are funds that belong to other people other than the owner. And these liabilities can either be current liabilities or non-current liabilities. So the assets of the business can be explained in this accounting equation to be the sum of the capital, that is the owner, fund, plus the liabilities, which is the money belonging to people outside the organization, that is the form of borrowing. Now, this equation, you can also change it into any other form. Like for example, you can bring capital to this side, then you have to say now that would mean that capital is equals to asset minus liabilities. So this is not the only form you may find this equation in. As you can know that you can change the form of this equation. If you want to start there with capital, then it would mean that capital is equals to assets minus liability. And some books denote it like that. So do not be confused, why is it denoted differently? It's the same equation. So, on the introduction to accounting, we also need to know what qualities should accounting information possess. Now, this accounting information that is so important, that is required by so many users, what qualities should it possess? So, qualities of accounting information are what makes it useful, what makes it important, what makes it capable of providing use or providing relevance to the users. So there are 2 things that we look at in the qualities of accounting information. Those qualities, some of them relate to the content. How is the content that is provided? What is inside the financial statement? That content, how good is it? Then the other quality looks at presentation. How is that accounting information presented? Is it presented in a way that is quality? So we are going to look at what is now the characteristics of content. We're also going to look at what are the characteristics of presentation that makes this information quality. So let's start with content. So we were talking about the qualities relating to content. the content in the financial statement have to meet two key qualities. Number one is relevance. That information has to be relevant. Now, the question is, what is relevant? Relevant information has three sub-qualities. Relevant information has what we call predictive value. It can help you to predict, even if to a small degree, what is likely to happen. That is relevant information. It also has feedback value. It is able to confirm what you had predicted. And finally, it should be timely. That is timeliness. So we find that relevant information should be provided in time. That is good time before it loses its ability to influence decision making. Now, for example, if you want information about a business so that you can evaluate whether to invest or not, that information is relevant to you if it is provided in a timely manner. That is before you make the decision. So relevant information in the financial statement has to have those three key characteristics. Another major one is reliability. Can that information be relied on? That is a question you're asking yourself. Can we rely on the information in the financial statement? Again, for information to be reliable, it has to have these 5 sub-qualities. Number one, there is faithful representation. Does it faithfully represent what it purports to represent? Does it faithfully represent what it is expected to represent? Does it faithfully represent what ordinarily it would be expected to represent? Another sub-quality is neutrality. Neutral, from the word neutral. Maybe for those who are supporters of different teams, there also exists another category who do not support any team. I would say neutrality is similar to sitting on the fence, where you are not either on this side or the other side. So accounting information should possess such key neutral ability to mean that it should not be suggestive, it should not be biased, it should not lead the user towards making a predetermined decision. So neutral information is not biased, it's not suggestive, it is not directional in terms of guiding someone make this decision. It leaves you as a user to be able to use your own due diligence to make the decision. Another one is completeness. So we are saying here that reliable information is that which does not suffer from any deficit in terms of completeness. That information has all that it is required to represent. That is, it does not have omissions, whether deliberate or not. It has all information in it, that it is complete. Another characteristic is verifiable, that which can be proven, that which there exists objective evidence about it. So verifiable information is one, for example, which is objective. If you say that there was a purchase probably of an asset, we have to be able to verify and see the physical asset. You have to be able to see the purchase orders. We have to see the bank statement to verify even the payment. Such kind of information is what you are calling verifiable. It can be proven. That is what will make that your financial statement reliable. And finally, it is prudent in terms of there is no overstatement. Prudence requires that you do not overstate the worth of your assets. You do not understate the worth of your liabilities. You are very prudent, you are very conservative in terms of reporting the truth. So prudence has to be there for information to be reliable. And these are the key qualitative characteristics that relate to content. So we're going to look at qualities that relate to presentation, how the information is presented to the users. Guys, we need to know that this information has to be presented in a way that there is understandability. Understandability, we cannot assume that all users can understand financial information, but we are going to present it in a simplistic manner, in that we are not going to use jargon. other than where it is completely unavoidable, where those are accounting terms and they have to be used in that manner. But we are saying that the users also have to study the information with due diligence. They also have to have at least knowledge in business, so that we do not compromise on other key content issues by trying to make it as simple as possible. So another one that relates to presentation is comparability. Financial information should be presented in a way that it is comparable, and comparability is over time within the same organization, so that you can compare last year and this year. Comparability also can be with peers, those of the same industry. You are able to compare yourself, how you are doing against your peers in the same industry. So for us to achieve comparability, there has to be consistency. And we are going to come to this later. But consistency is making sure you apply the same principles and policies the same way over time. Like for example, we cannot keep on changing the method of depreciation from one year to the other. That would lead to inconsistency in application of a policy. So we have to have a standard policy for depreciation, and we have to follow it year after year. So consistency is very important. It is also about making sure that like items or similar items are treated in a similar manner from year to year, so that the accounting information is now therefore comparable amongst organizations and within the same organization over time. Those are the qualities relating to presentation. Now, we have to ask ourselves several questions that we can use to conclude this tutorial. The first question would be, give an example of a situation where two qualities of financial statements clash and explain how this can be resolved. Now, for example, when I say that accounting information has to be relevant, then another quality is understandability. Now, there is a clash here because if you make accounting very simple or financial statements information very simple, it may lose the relevance. So what do? Are we going to avoid relevant information just because it cannot be understood? Or are we going to ignore understandability and report even relevant information where it is not understandable? And of course, relevance outweighs understandability. So if information is relevant, it has to be presented whether it is understandable to key users or not. That is a case where there is a clash between some qualities of financial statements. Another question would be distinguished between financial accounting and management accounting. I'm going to ask you to find out what are the key differences between financial and management accounting. I'm going to give you two. Number one, while financial accounting focuses on both internal and external users, management accounting focuses on internal users, that is the management. That is number one. Number two, while financial accounting is regulated, it has what we call the International Financial Reporting Framework. Management accounting is not regulated. We provide it as per the as per the needs of management. But the others, we are going to look at another video or another tutorial when I'll be introducing management accounting, when you are going to look at the key differences that are there between financial and management accounting in another video. Finally, you may also, from the discussion that we had about the classification of users, we just categorize them into all users. I would wish that we now categorize them into internal users and external users. Internal users would be people like shareholders, managers, employees. Those are internal users. External users are people outside the organization, customers, government, researchers. This would be external users. So simply here is going back to the users of financial statements as we discussed them and classifying them either as internal users or external users. Those are just some of the questions that will be arising from this introduction tutorial to accounting. So thank you very much. If you have enjoyed this video, I wish that you would like, share and subscribe. Thank you.